Welcome back to the Deep Dive. Today we're looking at a company that, for a long time, really flew just under the radar for most people. Yet its technology is, it's foundational to pretty much every big shift happening in the digital world.
It really is.
We are peering inside Broadcom Inc., ticker symbol AVGO.
And we're looking at what you could call a profound structural anomaly here. Think about it for a second.
Okay.
How can one single company be totally indispensable to the white-hot AI revolution?
Right, supplying chips to Google and Meta, all the big players.
All of them. And at the exact same time, run its huge software division with the, let's say, cold, ruthless efficiency of a private equity firm.
That's the perfect way to put it. This is the deep dive into the convergent titan. And our mission today is really to unpack Broadcom's unique operational model. We need to get into the mechanics behind this convergence of, bleeding-edge silicon on one hand and legacy software on the other. And I think most importantly, figure out if its trajectory justifies this massive, massive re-rating of its valuation.
A re-rating that's just been astronomical. It's gone from a typical sort of industrial tech multiple to a straight-up AI growth multiple.
It's a whole different ballgame now.
And the whole thesis, really, for Broadcom is powered by what we're calling the dual flywheel.
The dual flywheel.
Yeah, you have these two engines. They operate almost independently, but they funnel all that cash flow right back to the corporate center.
So what's the first one?
The first flywheel is the reason for that high valuation premium, the AI infrastructure supercycle.
Okay.
Broadcom isn't just a player here. They are, you could argue, the second most critical enabler of the entire AI boom, right behind NVIDIA.
Wow. Okay. So they're the sovereign power in custom silicon and high-speed networking.
I got it.
And the second flywheel.
That's the software capital engine. This is where that private equity playbook really kicks in.
The ruthless efficiency part.
Exactly. They go out and buy these mission-critical software franchises, LSI, Brocade, CA, Symantec, and now the huge one, VMware.
And they just apply this surgical focus on cost.
Absolutely surgical. The goal is simple: maximize cash and generate these just staggering operating margins. They routinely get over that 60% mark.
60%. That's incredible.
And the numbers, the financials really confirm the scale here. For fiscal year 2024, Broadcom reported $51.6 billion in revenue.
Which is up, 44% year over year?
A phenomenal 44%. Yeah, mostly because of VMware being integrated. But here's the number that you, the listener, really need to hone in on.
Okay.
They delivered $19.4 billion in free cash flow, FCF. And they maintained a 38% FCF margin while they were shouldering all these massive integration costs.
That kind of cash generation is just, it's almost unheard of for a company going through that kind of transformation.
It is.
FCF, as we always say, it's the truth metric in these big M&A deals. But this dominance, it comes with some serious tension, some real peril.
It does.
The company's now trading at a forward price-to-earnings ratio of over 30. And for context, historically, before this whole AI boom, Broadcom was priced like a boring industrial company.
Right, around 15 times PE. That was the norm.
So that premium, that 30x multiple, it is explicitly pricing in flawless execution.
Absolutely flawless execution. It implies the market is completely certain they're going to hit their really audacious AI targets. They're projecting something like $50 billion in AI revenue by 2026 or 2027.
And we have to look at the other side of that efficiency coin. The other big tension point is the customer fallout, the potential churn from this really aggressive monetization strategy they're using on VMware's customers. Broadcom's making a huge multi-billion-dollar bet that operational lock-in, that the sheer cost of migration is just powerful enough to completely override how their customers feel.
It's a fascinating high-stakes bet.
Okay, let's unpack this. And I think we have to start with the man who built it, CEO Hock Tan, and his unique private equity playbook. What exactly is this operational doctrine that's turned Broadcom into this, $700 billion powerhouse?
The whole thing, this whole structural anomaly we're talking about, the mix of cutting-edge tech and legacy software extraction, it is entirely the creation of CEO Hock Tan.
Right.
Ever since he took over the predecessor company, Avago, way back in 2006, the strategy has been just relentlessly consistent, predictable, disciplined.
Broadcom operates less like a typical tech company.
Much less. They're not focused on some 10-year tech roadmap or slow organic growth. It's much more like a systematic, financially engineered roll-up.
So that doctrine really dictates everything, what they buy, how much they pay for it.
And crucially, what happens in the first 90 days after a deal closes. It's also really important to understand what they don't buy.
Okay, what don't they buy?
Broadcom fundamentally avoids the high-growth, high-risk moonshots, the speculative R&D stuff. They are not interested in the next startup that might be a huge success or a huge failure.
They want predictability.
Precisely. They only target established, mature, mission-critical franchise assets. And these targets have to have three qualities, non-negotiable.
Which are?
High switching costs, an entrenched market position, and critically, a very low risk of being disrupted.
And when you look at their shopping list, LSI, Brocade, CA, Symantec, VMware, they all fit that profile perfectly.
Every single one. The market often saw these companies, especially the software ones, as you know, legacy assets, slow growth.
Right, because they weren't as sexy as the cloud companies.
Exactly. But Tan saw something different. He saw these assets with incredible protected revenue streams that were, in his view, just mismanaged.
Plagued by bloated R&D and too much sales and marketing spend?
You got it. He saw cash cows just waiting to be optimized.
And that optimization happens through this operational surgery playbook, a three-step process.
A meticulous three-step process that starts, the minute the ink is dry on the deal.
So step one is swift and decisive. Divestiture.
Right away. They immediately sell off anything that's not core, anything that doesn't contribute to that high-margin, sticky revenue.
Like with Symantec, they sold the consumer business. With VMware, they got rid of the end-user computing and carbon black units.
Immediately. It's all about ruthlessly narrowing the focus to maximize profit and just kill the overhead.
Okay, then step two is the one they're famous for, cost rationalization.
This is where that private equity mindset really, really shines. They just slash selling general and administrative expenses. S&G.
To the bone.
To the absolute bare minimum. Reports suggest they cut it down to what's needed to service only their top customers, the top 500 or 2,000 global accounts.
So if you're a smaller customer, a long-tail customer, your support just vanishes.
It evaporates overnight. Your relationship with the company is gone.
That must be a brutal culture shock for the company they acquire. Are there stories about what that feels like when Hock Tan's team comes in?
Oh, absolutely. And the reports are all consistent. The culture shift is immediate. It's jarring.
I can imagine.
For a company like VMware, which was built on this idea of wide distribution and high-touch engineering support, people described it as a clinical amputation.
Wow.
Entire layers of middle management, non-essential R&D staff, they're just eliminated. Sometimes in weeks, the message is crystal clear. If your project isn't generating measurable near-term revenue, it's gone.
And R&D gets refocused.
Strictly. It's refocused on protecting the core moat. Just making sure the current products stay best in class. They get rid of what Broadcom internally calls science project research.
So invest just enough to keep the franchise, but not a penny more on speculation.
That's the playbook.
Which brings us to step three, which is leveraging that new cost structure. Pricing power assertion.
Exactly. Once they've confirmed the operational lock-in, those high switching costs, they use that leverage to impose really aggressive price hikes and move customers to higher margin contracts.
And the VMware integration is the ultimate test of this entire doctrine, isn't it?
It's the multi-billion-dollar final exam. They didn't just buy VMware. They bought the control point for the entire private cloud infrastructure of the world's biggest companies.
And the financial goals they set were just stunning. Broadcom said they could almost double VMware's EBITDA from about $4.5 billion to, $8.5 billion in 3 years.
An incredible target. That kind of margin expansion requires, surgical precision.
So how are they doing?
The early results from Q3 2025 show they're running ahead of schedule. The infrastructure software gross margins have already shot up to an elite 93%.
93%. You only get there through that radical cost cutting and forced bundling.
That's the only way. And their strategy is based on that aggressive segmentation we talked about. They made an explicit pivot to focus only on the top 2,000 enterprise customers, period.
So this isn't just a preference, it's a systematic abandonment of everyone else. Small and medium businesses are just out.
Out! The termination of all those reseller agreements for smaller accounts was the proof. They did the math and figured out the cost of supporting hundreds of thousands of small businesses just dragged down the overall profit margin.
So focus only on the big, inelastic customers to maximize profit per employee, per support ticket, per everything.
It's brutal, but from a purely financial perspective, it's undeniably effective.
And what's so fascinating here is how this incredibly profitable software engine, the cash machine, is what funds the innovation and drives this huge market re-rating in their other business.
The semiconductor segment, it's a perfect synergy.
Absolutely. The semi division is the innovation engine. It's the reason the stock's valuation is spiked. If the software story is about financial mechanics, the semiconductor story is one of technological necessity and pure market dominance.
Right, and it's still the majority of the business, 58% of total revenue,
Yeah.
or about $30.1 billion in fiscal 2024.
This is where Broadcom really becomes that second sovereign of AI infrastructure, just behind NVIDIA.
And they have a deep moat in two really key areas.
Yeah.
Custom silicon, or ASICs, and the high-speed networking fabric that makes AI clusters work.
Okay, let's start with the custom silicon, the ASIC hegemon. NVIDIA cornered the market on general-purpose GPUs for AI training, but Broadcom commands something like a 70% market share in custom ASICs.
It's a quiet moat, but it's an incredibly defensible one. And to really get it, you have to understand the basic problem that the hyperscalers are facing: Google, Meta, all of them.
They're running billions of very specific, very repetitive AI operations every single day.
Billions. Search ranking, content recommendations, image tagging, real-time inference, all of it.
And general-purpose GPUs are powerful, obviously, but they're incredibly expensive, both to buy and to operate because of the power consumption. Plus, you can't always get enough of them from NVIDIA.
Exactly. So for the biggest players, the driving factor becomes TCO, total cost of ownership. For a huge, predictable, very specific workload, spending hundreds of millions upfront to co-design a custom ASIC with Broadcom pays off massively over a 5-year period.
Because that custom chip is way more efficient and cheaper to run for its one dedicated task than a generalized GPU.
Infinitely more efficient. That focus on TCO is why Broadcom's ASIC business is absolutely soaring.
And Broadcom isn't just a vendor in this relationship, they're a co-design partner. I mean, the biggest one is with Google, right? The tensor processing unit, the TPU.
That's the most critical partnership.
Yep.
The TPU is the silicon heart of Google's entire AI infrastructure, and Broadcom provides the absolutely critical proprietary IP blocks that make it possible.
What kind of blocks are we talking about?
We're talking about specialized SerDes, that's the serializer deserializer for high-speed data movement, memory controllers, and the advanced packaging, specifically CoOS chip-on-wafer on substrate packaging.
Let's stick with the SerDes for a second, because this is a technical moat most people don't really appreciate.
They don't.
The SerDes is what dictates how fast data can physically move, both inside a chip and between chips. And if you can't move the data fast enough, your whole AI cluster just stalls.
It doesn't matter how powerful the compute engine is, the data has to move. And Broadcom has a multi-decade lead in 112G and 224G SerDes tech.
And that IP is incredibly hard to replicate.
Billions in R&D and decades of expertise. So when Google or Meta designs a new custom chip, they have to go to Broadcom for that high-speed data layer. It's not optional.
So as Google scales up its Gemini models, that directly benefits Broadcom.
Directly, through IP licensing and manufacturing revenue.
And the big valuation shift in 2024 was really driven by the market realizing this ASIC dominance wasn't just about Google anymore.
That's the third customer story. We already knew they were ramping up production for Meta's custom AI chip, the MTIA. That's already a multi-billion-dollar business.
Right.
But the reports in late 2025 confirming this massive new engagement with a third undisclosed customer.
Widely rumored to be OpenAI.
Widely reported to be OpenAI, yeah, for a custom inference chip. That was the real catalyst.
And that single deal is projected to add, what, another $10 billion in revenue?
Over its life cycle, yes. And it fundamentally validates the market's theory about bifurcation.
Meaning the world needs NVIDIA for general-purpose training.
But it desperately needs Broadcom for hyper-efficient custom inference, the part that actually scales to billions of users every day. It confirms Broadcom is a must-have supplier.
Okay, so let's pivot to the second pillar of their AI dominance, networking. If the ASIC is the brain, the network is the nervous system.
A perfect analogy. Because the main bottleneck in modern LLM training isn't compute power of one chip. It's the speed at which thousands of chips can talk to each other, what engineers call east-west traffic.
And Broadcom basically has a monopoly on the switching and routing silicon for these clusters.
They do. Their flagship products are the industry standard. Specifically, you have to look at the Tomahawk series. The Tomahawk 5 at 51.2 terabits per second is the fundamental building block.
It's the chip that makes sure the massive data flows for LLM training don't just choke the whole system.
Exactly. And then for routing, they have products like the Jericho 3 AI. That chip is specifically engineered for AI scale-up needs. It has perfect load balancing across thousands of ports.
So no congestion, no latency spikes, which are fatal for training.
Fatal. Which brings us to this key strategic battle that's happening right now. Optimized Ethernet versus NVIDIA's proprietary InfiniBand.
Right. NVIDIA pushes InfiniBand, saying its low latency is essential for training.
And Broadcom is leading the counterattack through the Ultra Ethernet Consortium, the UEC.
Their argument being that optimized Ethernet can basically match InfiniBand's performance.
But with way better economics, better interoperability with different vendors, and more flexibility.
And is this just marketing, or is there a real technical architecture behind it?
Oh, it's very real.
Yeah.
The UEC is proposing new congestion control mechanisms, specialized data protocols, all built on top of Broadcom's Tomahawk switches.
So the strategic goal is to keep the entire AI network layer an open market running on their chips, instead of a closed, proprietary NVIDIA ecosystem.
You've got it. And the market trends are showing that the hyperscalers are increasingly choosing Ethernet to avoid that vendor lock-in and high cost of InfiniBand. It's a huge tailwind for Broadcom.
And finally, as we move past 400G and 800G networking, copper cables just can't keep up. The future is optical.
The future is absolutely optical, which brings us to Broadcom's leadership in digital signal processors, or DSPs. These are the complex chips inside the optical transceivers.
They convert the electrical signals to light and back again.
And the move to 800G and 1.6T networking is driving exponential demand for these high-margin DSPs. It's a vertically integrated moat.
So Broadcom sells the switch, the Tomahawk,
The router, the Jericho.
and the critical optical component, the DSP, to connect it all. They're selling the entire nervous system.
Right. And we can't forget the cash cows that anchor the whole business. Wireless and broadband. Apple is still Broadcom's single biggest customer, about 20% of their revenue historically.
Right. They supply the FPRR filters and the Wi-Fi Bluetooth chips for the iPhone. And for years, the market has been terrified of this replacement risk.
Apple's Project Everest to design those chips in-house.
But the FBR moat has been incredibly hard for them to cross.
Incredibly resilient. The manufacturing requires this extreme precision in thin film deposition and material science that's just proven much harder to replicate than anyone thought.
So that led to the big de-risking event in 2023 when they signed that multi-year extension with Apple.
Exactly. That secured this high-margin revenue stream through at least 2026 or 2027. It basically neutralized the single biggest risk in their semiconductor business for the near future.
And broadband is just a stable duopoly, providing predictable cash flow.
A stable cash cow that helps them pay down debt while the AI engine really revs up.
Okay, here's where it gets really interesting for me, how they're generating these huge software profit margins, while at the same time creating just enormous customer outrage.
It's the VMware paradox.
It's the ultimate tension between financial engineering and customer happiness.
The whole $69 billion VMware acquisition was built on a counter-narrative, the belief in the private cloud as a durable, long-term thing.
Right, a thesis that really pushes back against the idea that everything is just going to end up on AWS or Azure.
And for big companies, the logic is pretty compelling. Not all workloads can move to the public cloud.
You've got cost volatility, latency issues for critical apps, and all these data sovereignty rules, especially in finance or healthcare.
Exactly. And VMware Cloud Foundation, VCF, is the standard on-premise operating system for running that kind of secure internal cloud.
So what was Broadcom's strategy after the acquisition?
A forced and very aggressive transition of the business model. Step one was just killing perpetual licenses, the old buy-it-once CapEx model. Everything is now subscription, an OpEx model.
And at the same time, they're grabbing way more wallet share by forcing customers to bundle products.
You got it. They take things that used to be separate, vSphere, VSN, NSX, and force customers to buy them all together in one big, expensive VCF SKU.
And subscription revenue is higher margin, more predictable, and feeds that massive FCF generation.
Which brings us right to the paradox. The huge customer outrage versus the cold, hard financial reality of lock-in.
And let's start with the outrage, because the stories are just wild.
They are.
Industry forums are filled with people talking about renewal quotes going up 300, 400, even 500%.
Simply because they're now forced to buy a bundle with products they don't need or want.
And the small and mid-market customers have been, completely abandoned.
Systematically, they terminated thousands of smaller reseller agreements, leaving tens of thousands of organizations just orphaned.
I get the financial logic, cutting low-margin support. But at what point does a 300% price hike make a CIO say, okay, that's it, we're leaving? When does the lock-in start to crack?
That is the critical risk. But Broadcom's bet, which has been correct so far, is on the sheer inertia of their biggest accounts. Churn among those top 2,000 enterprise customers is still remarkably low.
They just correctly calculated that for a giant bank or a hospital, the operational risk of trying to rip out and replace their core virtualization layer is it's catastrophic.
The migration cost, both in dollars and in operational disruption, is higher than the outrageous price hike.
It's incredible.
It doesn't matter if the new price is 500% higher. The alternative, a multi-year, multi-million-dollar project that could paralyze your business, is just too scary. And reports show that about 70% of those large accounts have already transitioned, grudgingly, to the new VCF contracts.
So the playbook worked. The bet on lock-in paid off.
It's a stunning validation of the strategy.
But let's talk about the alternatives for a minute. For that mid-market that they abandoned, what's gaining traction there? Could a competitor build up enough scale there to eventually challenge the enterprise core?
That's certainly the hope of the competitors. In that mid-market, we are seeing more adoption of things like Nutanix, which is a hyper-converged platform, or even open-source solutions like KVM or Proxmox.
Are they technically mature enough?
For smaller environments, yes. But the challenge is always enterprise compatibility.
The really complex features.
Right. Advanced site recovery, deep integrations with legacy systems, specific security certifications. The open source stuff often can't provide that with the same level of guaranteed support. So until a competitor can offer a seamless, low-risk migration path for all those features, the enterprise core stays locked in.
Got it. And to round out the software engine, the legacy stuff, CA, mainframe, Symantec, they're just run for cash, basically.
Pure cash flow generation. Minimal reinvestment, low single-digit growth. But those best-in-class 60% plus operating margins, they are the funding mechanism that lets Broadcom pay down all that M&A debt.
So if we connect this to the bigger picture, Broadcom's key financial advantage isn't just the revenue they generate. It's the massive structural costs they systematically avoid.
That's the key. That's the whole financial architecture.
Yeah, let's dig into that. Broadcom's growth is all about these big step functions from M&A, not slow organic growth. Revenue has gone from, $6.8 billion in 2015 to a projected $63.4 billion in 2025.
It's an aggressive expansion, and it needs an equally efficient financial structure to support it.
And that efficiency is all measured in free cash flow, FCF.
Their FCF margin has historically been elite, around 49%. And even during the chaos of the VMware integration, it only dipped to 38%.
Generating almost $20 billion in cash during a peak integration year. That tells you everything about the quality and stickiness of the revenue.
And that FCF is the lifeblood. It supports the dividend, the debt paydown, and the huge share buybacks.
So what's the critical engine driving that cash conversion?
The fabless advantage. This is so important to understand why they are structurally better at this than their peers. Broadcom outsources 100% of its chip manufacturing.
Mostly to TSMC.
Almost entirely. And because they don't own, build, or maintain these insanely expensive semiconductor fabs, their capital expenditures, their CapEx, are negligible.
We're talking 2-3% of revenue, like $150 million in a quarter where they make almost $16 billion in sales.
Exactly. Now contrast that with an integrated competitor like Intel, an IDM, an integrated device manufacturer.
Intel has to spend tens of billions every year, 20-30% of their revenue on CapEx, just to keep up.
Broadcom avoids that massive annual cash drain entirely. That $15 to $20 billion difference in CapEx for Broadcom converts directly into free cash flow. It is a massive structural advantage.
Which is why FCF, not GAAP net income, is really the best way to value this company.
Absolutely, and that focus is vital because of another tricky financial item, stock-based compensation, or SBC.
Right, which jumped a lot after the VMware deal, from about $2.2 billion to $5.7 billion.
Mostly from assuming VMware's equity and the retention grants needed to keep key engineers.
And while they exclude that from their non-GAAP numbers, SBC is a real cost to shareholders through dilution.
Yeah.
Your slice of the pie gets smaller.
So Broadcom's counter move is to use that massive SCS stream for an aggressive programmatic share buyback program.
They spent $4.2 billion on buybacks in just one quarter.
Which effectively neutralizes the SBC dilution and keeps the share count stable over time. It's very disciplined.
Okay, shifting to the balance sheet, let's talk debt. The VMware deal meant taking on a lot of leverage. Total debt ballooned to around $66 billion.
And their gross debt-to-EBITDA ratio spiked to about 3.5 times, which is high. But the market was okay with it because those software cash flows are so predictable.
And the plan is to aggressively pay that down.
Very aggressive.
Yeah.
Use the FCF to get that ratio below 2.5x within 2 years. They have to do that to maintain their investment-grade credit rating.
Okay, and finally, the big consequence of the Hock-Tan playbook is a balance sheet just dominated by intangible assets.
It is. As of 2024, the company carries $138.5 billion in goodwill and another $45 billion in intangible assets.
And that goodwill is just the premium they paid over the book value of the companies they bought.
Which is the big structural risk of the whole roll-up strategy. If the VMware integration fails to hit its targets, or if the Apple deal suddenly falls apart.
They could be forced to take massive non-cash impairment charges.
And while that wouldn't hit cash flow immediately, it would hammer their GAAP earnings, and more importantly, it would signal to the market that they overpaid. It's the shadow hanging over all this success.
Okay, let's pull all these threads together now and talk about valuation. Broadcom spent years trading at a conglomerate discount, 12 to 15 times forward PE.
Right, because the market didn't know what to make of it. Mainframe software, Wi-Fi chips, AI networking. It was a weird mix.
But the AI boom has completely shattered that discount.
Shattered it. The market has re-rated Broadcom from a complex value stock to an AI growth enabler. They now trade at a forward PE near 35 times.
Putting them right in the same group as high-growth players like Marvell.
Though still a bit behind NVIDIA, of course. But this shift, it requires a lot of conviction in their future cash flow.
So what does that price actually imply? I mean, when analysts run a DCF, a discounted cash flow model, what does the math say?
The math says that to justify today's market cap, Broadcom has to grow its free cash flow at a staggering CAGR of 15% to 20% for the next 5 years.
And that growth has to come from perfect execution on all fronts.
All fronts. The AI segment has to hit that $50 billion revenue target, and the VMware margins have to hold up without major churn. It's a very, very ambitious forecast.
So let's break down the scenarios analysts are using to model that. What's the path to $1 trillion, or what's the risk of a big correction?
Okay, so you have scenario A, the AI bull case. Analysts give this about a 40% probability. This is the flawless execution scenario.
AI revenue hits $50 billion by 2026, driven by Google, Meta, and the OpenAI deal. And VMware lock-in proves to be absolute.
In that case, the outcome is just exponential. Broadcom could be generating over $60 billion in free cash flow by 2027.
And if you put a 30x FCF multiple on that.
You are looking at a market cap of $1.8 to $2.0 trillion. That's the path.
Wow. Okay, then there's the base case.
Scenario B, the base case. Also about a 40% probability. Here, AI revenue grows strongly, but maybe stabilizes closer to $35 billion. CapEx cools a little, VMware works, but they see some churn in that mid-market they abandoned.
So in that case, FCF grows steadily to maybe $45 billion. The stock still compounds nicely, maybe 10–12% total annual returns from dividends and buybacks.
It's a solid, high-quality return, but it doesn't really justify the dramatic premium that's priced in today.
And finally, the bear case.
Scenario C, the bear case. Maybe a 20% probability. This is where multiple things go wrong at once.
Hyperscalers cut CapEx, Apple finally succeeds with Project Everest and brings its chips in-house.
And critically, a mass migration of VMware customers to a real alternative, like Nutanix or a mature open source stack.
In that worst-case scenario.
AI revenue stalls over revenue contracts because they lose Apple, and the market multiple just violently compresses back to its historical 15x. That would mean a big correction, 30–40% down from the highs.
Before we wrap, let's touch on governance and insider alignment. Hock Tan's pay structure is pretty unique.
It's a masterclass in alignment. His big 2023 grant was a performance stock unit award that vests only if the stock price hits some formidable targets over 5 years.
And he gets no annual cash bonus during that time.
It's an all-in package. It forces him to deliver that bull case scenario to get paid. His interests are completely aligned with shareholders.
What about the insider selling we've seen?
There has been notable selling by Tan and others in 2024 and 2025. Now, some of that is just necessary for taxes or diversification after decades. Tan still holds over 1 million shares.
Yeah.
But the consistent selling at record highs does suggest they're prudently taking some chips off the table, recognizing that the valuation is at historic peaks.
So beyond the valuation models, what are the big structural existential risks that could just derail this whole thing, no matter how well Hock Tan executes?
I see 3 big ones. First is the Apple concentration risk, Project Everest. Despite the extension, Apple's long-term goal to in-house those chips is still the single biggest specific threat. It could wipe out $8 to $10 billion in high-margin revenue overnight.
Okay, what's number 2?
Pure geopolitical vulnerability. Broadcom is 100% fadeless. They are existentially reliant on TSMC in Taiwan for all their advanced AI chips.
The 3-nanometer nodes, the CoWoS packaging, all of it.
All of it. Any conflict in the Taiwan Strait would instantaneously halt their ability to ship product. There is no alternative foundry capacity anywhere in the world that can handle their needs right now. It is a massive single point of failure.
A risk they have no direct control over.
None. And finally, regulatory headwinds. The aggressive bundling and pricing with VMware has already drawn intense scrutiny from the EU and the FTC.
So while the deal is done, They could face huge fines or be forced to change their behavior in the future.
And critically, that regulatory scrutiny probably means they're effectively barred from any more massive M&A. The Hawk-Tan playbook of growth by acquisition is likely over. They have to grow with what they have.
So what does this all mean for you, the listener? Broadcom is this masterpiece of strategic and financial engineering. They are perfectly positioned to capture value from both the AI CapEx cycle and this captive enterprise software base.
They're benefiting from a true, perfect storm of tailwinds. And the cash flow generation is just phenomenal. It's a financial truth backed by real contracts and tech leadership. That $50 billion AI revenue target isn't just a dream. It's based on concrete design wins.
However, the takeaway here is that the easy money, the money from that initial valuation re-rating, has probably already been made. The market has priced in the near-flawless execution of that bull case.
So investors today are making two core bets. First, on the long-term durability of this AI supercycle, and second, on Broadcom's ability to maintain its duopoly status with NVIDIA while navigating these huge geopolitical risks.
You're basically betting that high switching costs can continue to override customer anger, a financial calculation that has worked perfectly so far.
Exactly. And for listeners who like to monitor the total market temperature, evaluating if companies are hitting the growth rates needed to justify these valuations, tracking that gap between cash flow and valuation multiples is absolutely key.
Which brings us to our final provocative thought for today. Broadcom built its software empire on proprietary lock-in, where the risk of leaving is higher than the price hike. But as the world, and even Broadcom's own hardware division, champions open, interoperable standards like the Ultra Ethernet Consortium, how long can their reliance on captive pricing models really last before a technically feasible, economically superior alternative finally emerges for their biggest, most profitable customers?
Something definitely worth pondering as that battle between proprietary systems and open standards continues to shape the future of the cloud.
Thanks for joining us for this deep dive. We'll see you next time.